Sorry, guys. I think can we start now?
Yes, we can. I think we can.
Zach,
Yes, we can. I think so.
Okay.
Zach, do you think there is an issue with the joining, or the others didn't have that issue?
No. It was just an oversight. Okay, I think I had not received the notification to accept in meeting.
Oh,
So
so
normally when you create a meeting, of course, you have to the admin has to let everyone in if it's not an open meeting.
this is not an open. You changed it.
Yeah, I think I did not adjust those settings. Yeah,
Oh, okay. Because
but
maybe
I had not
someone.
seen your notification. I think that's why you were
Yeah, I
stranded.
tried like 10 minutes ago, and it was still not going through.
Okay, anyway, my apologies for now. I think we can proceed.
Yes.
Is it okay?
Yeah, it's okay.
Yes, we can.
Fine. So let me welcome you once again. And we had agreed last time that we are going to start with some questions that Elizabeth had.
Mm-hmm.
So Elizabeth, I think
Okay,
the
Zach,
floor
I
is
was of
yours.
the opinion
Yes.
instead of us taking this early minutes on questions, maybe you
Yes.
can start your session and then towards
Mhm.
the end,
Yes.
because I still have the questions with me and I know you still have the knowledge, you can still go back to that last session.
Okay.
We start with the session and then we finish with the questions in order
Fine.
to save some time.
Okay. Fine. I think that's okay then.
Yeah.
So as we had agreed last time, we decided that we are going to be drafting our own accounts, which we are going to be using now from this point onwards. So let me share a moment.
Okay.
Are you able to see my screen?
Yes, maybe you can zoom a little bit,
Yeah.
just a little bit. Yeah, that's fine.
Is it fine or is it too much?
Uh,
Okay. Just reduce it.
what was
How
before
is
was
that?
fine.
Yeah. Now it's yeah. Now it's okay now. I think so.
Elizabeth, I think using a phone. Are you okay? Are you able to see?
Yeah, it's okay. It's fine. I can see clearly.
Okay, fine. So if you remember the audit flow, we said that the first thing that you usually receive from the client is the trial balance. So I just prepared a sample trial balance here. Just unfreeze this. So these are trial balance. Now for the client trial balance, it's going to have three sections. That's the opening balance, transactions, and closing balance. So the year we are dealing with in this case is 2022. So we had no opening balance because we are just assuming that this client started trading in 2022. Okay. So these are the transactions for the various items. We have fixed assets, current assets, equity and reserves, long-term liabilities, short-term liabilities, current liabilities, that is, incomes and expenses. Okay. So anyway, because in most cases the client is going to be using a system, the bottom line is, the trial balance is going to balance either way. The opening balance, transactions, and the closing balances. So once we receive this trial balance now from the client, the first thing that you need to do is now open an extended trial balance. Okay. So that in case you are going to be having any issues or any changes, you'll be able to edit or adjust, make your adjustments in the extended trial balance. So, anyway, in most cases, I'm going to be referring it as a TB, which is now the trial balance, because it's just the short form of that. So basically what you do, I can just copy this, then I go to my TB, extended TB, then I just paste, okay? Just a moment, okay, fine. Now, immediately you get this, you can remove the closing balance section because okay, instead of removing it, I'm just going to, I can rename it to profit and loss. Then I can have another section here for the balance sheet now. Then remember we said that you always need to have an adjustments or yeah, that's an adjustments column in case you may make any changes in the future. So just create an adjustments column here. Okay, so at this point, now what we need to do is define or determine which items need to go to the profit and loss section and which items need to go to the balance sheet. Okay. So let me start off by freezing this so that it's visible. Yeah. So the first thing you have here, we have these fixed assets. Of course, those automatically belong to the balance sheet because they are assets. And because we expect an asset to have a debit balance at the end of the day, we can now sum up the various items. So note that for balance sheet items, we have to take everything, including the opening balance. So you take the debit side, less the credit, then you add the debit for the transactions, less the credit, add the adjustments, debit, less the credit, and that's it. So we have that. Then we can copy this formula for the next two items. So we have them there. Now going down, we have current assets. Again, because they are using the same principle, we can as well copy or paste this formula here. Because we're going to be doing the same anyways, just summing up those items. And bank, again, these are also assets, so we can do the same. Now for the equity, this one behaves like a liability, the normal way where you say an increase in credit, an increase you credit, a decrease you debit. So I'm going to start with the negative sign, okay? So negative debit plus credit minus debit plus credit minus debit plus credit, okay? So we have that. Then the next thing, this is a bank loan. Again, it's a liability, so we can paste the formula there. Now for this one, again the same. Now note for tax, we have negative 700. Here I can remove these items because they are not supposed to be under the profit and loss section. Okay, just delete them. Okay, so for income, you can see it's a negative balance. So of course, this implies that this amount was relating to installment tax that was paid during that period. And because we have not finalized our situation to determine how much this client is going to pay, we only have a debit entry at the moment of 700,000, which of course relates to the installment tax that was paid for that period. So in the financial statements, we are going to see this adjustment being done later, okay? Now for the incomes, this one, of course, is a profit and loss item, meaning we only take the transactions and any adjustments you may have. So you take negative debit plus credit minus debit plus credit. So you get the amount and then you can copy for these two items there. Okay, then we scroll down. So we have now for expenses. So expenses, again, we take the debit side, transactions, so positive that, minus credit, plus adjustments minus the credit side. Then you can copy this formula for all the other expenses. Okay. Okay, so we have that. So now let's look at the totals here. And get the difference between the two. So we have that minus that. Okay, so you can see now, for the extended, of course, if you note the client trial balance had balanced, right? There was no issue there. If you look at the bottom line for this, you see the balances were the same, right? So it had balance, we have no issue. But now for the extended trial balance, because you're using a different approach, where you split the items or the balances into profit and loss and the balance sheet item. Now the difference is either profit or loss for that particular period. And you can see the amount should be the same for it to have balanced, okay? So basically the extended trial balance does not behave the same way as a normal trial balance, right? Now, after that, we are ready now to link this to the notes, okay? So the first note is NT7, which now is a note about the income and the expenses. So we go to the sales here, equals, then you go to the extended trial balance and get the figures that regard or relate to sales. So you can just move up. These are 3 items. So we have this, you add that, you add that. These are the various incomes that we had for that. Okay. Then we go to the expenses now. So salaries, we can get this figure from the trial balance. So this is the amount, 2.9. Then we have the various other expenses like telephone, for example. So telephone, again, get this from the trial balance. Telephone, this is 150, okay. Then we have tendering, printing, and stationery. So I think we have stationery. This, 20. Then from there we go to transport.
So,
Travel.
excuse me.
Yes, yes.
How are you linking these things? What is happening? As in, how are you linking? You are taking it from the balance sheet and back to your notes.
No. You see, right now we are dealing with the profit and loss. Okay. So what is happening is that, of course, linking simply is where you say equals and then you pick another cell. Okay. Now the cells that we are picking, the values that we are picking from those cells, these are the cells in the extended trial balance. Okay.
Oh, so you are linking those cells. After
yes.
Then you won't have to go back there again. It will be updating automatically.
Yes. So in case maybe, like for example, let's say that we have an issue and we need to make an adjustment here. Okay, like salaries, maybe there was either an understatement or overstatement. Then we make a correction here. We don't now have to repeat the process again because this figure, the final figure here, because they are linked, it's going to update automatically in the notes. Is that okay?
Okay. So this means the skills of Excel. I mean.
Yeah, but they are not necessarily that advanced because it's just equals, take a figure. Anyway, but you need to understand the basic skills anyway.
All right.
Do we have, by the way, anyone who has an issue with Excel before we continue? So I take it no one has an issue with Excel. Okay, fine. So let's continue. So transport and travel, get the figure. This is the figure, traveling. Okay. Then from there we go to, I don't think we had any accountancy, office running expenses. Of course, I'm only putting the expenses that are there in my extended balance. Yes, Elizabeth? Elizabeth, you have a question? Can you still hear me?
Maybe, Elizabeth, you can write on the chat if you, because we are not hearing you.
Okay, fine. I think we can continue. Maybe once she comes back, we're going to address the issue. I think she seems to have had an issue. Yes,
I'm
yes,
back. I'm
Elizabeth.
back.
Yes.
There's something I would like to understand.
Mhm.
So we started off with the client's trial balance,
Yes.
and from that we created the extended trial balance so that we can accommodate the adjustments and any
Yes.
changes.
Yes.
So that part.
Sorry?
What is it? So we are in the VAD. We are on the note.
Yes, yes. Now we are proceeding to the notes. Yes.
To the note. So what is basically the purpose of this note?
The
If you
notes.
don't mind. Yeah.
Yeah. Now, what happens is that for the financial, let me just give an illustration here. Let me go to. So you see, income statements are usually basically there are four. I mean, not income. Sorry, the financial statements are usually four. There is the income statement, which shows the financial performance of a company, balance sheet, financial position, SOE, or what we call statement of changes in equity. That shows the, what we call it, the equity status of the company, which technically is the share capital, reserves, such things. And then there's the cash flow. The cash flow is simply the movement of cash, okay? Showing, of course, you have this balance at the beginning and this at the end. So what items cause these differences, okay? Now, but if you go to the income statement, however, you are going to notice that we are getting the average, the totals, that is. Like, for example, you are talking of administrative expenses, other operating expenses, but the question is, what exactly comprises this? Okay, so you have to disclose, we have administrative expenses, which comprises of these various items, right? However, when you are presenting your financials at the end, the extended trial balance is not part of the financial statements, okay? Because that's like what you can call a rough, the normal way we used to do exams, and then there's the rough place where you do your calculations. So the extended trial balance behaves that way, or the purpose is that, right? To assist you with those computations.
Okay.
Did I answer your question?
Are
you satisfied now? Okay.
Yes, thank you.
So we can continue.
Yeah, we can.
Okay, fine. So office running expenses, I think we had that. So get that figure. Office expenses, that's the figure. Then we have, I don't think we had consultancy, marketing. I think marketing we had. Marketing, so this is 240. Then legal and professional fees, 60. Subscriptions, 45. Then donations, 100. Then we have fines, 80,000. Okay. So I think, I don't think we had any motor vehicle. We had repairs. That one is going to go to the operating expense because it's an operating expense. So I can just do the totals here. Sum. So 1.3, and I can do some borders for. Then now the overall figure here is going to be this subtotal plus the salaries, which were disclosed a bit differently. Okay. So the total administrative is 4.2. Okay, then we now proceed to the establishment of operating expenses. So there's insurance. The insurance amount 40,000. Then we have rent. $300,000. Okay, we never had any ICT related expenses, so we can just remove this. Licenses, that one we had. Licenses.
Zach.
Yes, David.
You have to admit someone. I think it should be an admin in a way, so that I can be admitting some of these people.
Yeah. Actually, I'm going to make it an open meeting. I think it's just an issue. Actually, let me just, I think I can even adjust it right now. Can I? Hi, Paul and Anthony.
Yes, hello.
Hi, yes, Zach. Hi. Yeah, my apologies for I think I never received that notification to admit you.
Oh, okay. I'm very sorry I joined late.
Yeah, karibu hatujaenda sana. So hopefully you are going to.
I think they waited for a bit long time, eh?
Yeah.
We should try to work on that.
I've made it an open meeting, so I think anyone now can join without necessarily having to wait for admission.
Yeah, that's better.
So that's okay. So anyway, Paul and Anthony, we were drafting some accounts. I think, Paul, we didn't have you last time, right?
Yeah. Unfortunately, I was caught up somewhere.
Well, no worries. Anyway, so we agreed that we are going to do our own accounts, our own financial statements that we are going to be using for purposes of these training sessions. So that's basically what we are doing right now. Okay. In case maybe you may have an issue, we are going to be addressed. But I think the only thing that maybe we have done that you are not there was the extended trial balance. But in case either Paul or Anthony, you have any issue regarding this, you can let us know, or any question regarding this. But hopefully, you are going to be able to follow along.
Sure.
Okay. So then we can proceed to the next item. I'm going to skip depreciation for now. Electricity, I think we didn't have that. Repairs. So what we are simply doing is just linking. We did the trial balance. Now we are linking the notes to the trial balance, getting the figures from the trial balance. Repairs, we have 96,000. Item. Then we have finance costs. We have bank charges here. Bank charges. So now let's confirm whether we missed any expense. You can just scroll. Yeah, I think we missed one. The NSSF employer seems to be the only one. So NSSF employer, that one you can combine with salaries, because anyway this. Okay, well, we can disclose them as separately as maybe other staff expenses, but for now we can just combine them with salaries, because anyway it's part of the salaries expense. So this, we can say this plus NSSF. Okay, so we have that. Now, before we move on to the notes relating or regarding the balance sheet, for us to confirm whether we did all the linking, whether there's any error in our linking, we can go to the income statement and now continue with our linking directly now to the income statement and check whether the balance that we are going to get is going to be the same as what we are getting the trial balance. So the first thing is the sales. So we get this from the note. That's okay, let me just hide some of these notes because they are not relevant at the moment. Okay, yeah, it's better. So we go to the income statement and we want to get our sales. So we can get sales from note 7, which is this. So the sales amount was 13.9, get that figure. Then we never had any other income, and delete that. Now the administrative expenses, this we get equals negative, because of course we are going to be, getting the difference. So it's always good to disclose your expenses as a negative balance or negative value for ease of understanding, maybe when you are going through the statements. So negative that. Then operating expenses, again, this is this. I think this one you never summed it up. So let's go back and do the summation. So this one, we just do auto sum. Okay, so 486. So you see now it was automatically updated. And that's now the benefit of linking, because immediately you do any changes, you just automatically captured. So the bank charges, these are the finance costs. We only had one, bank charges. Now note that for this client, anyway, there was a loan for this client, but I never captured the loan interests, which actually should be part of, I think that was an oversight. I didn't remember to include that. But anyway, if you have a loan, you should always have bank loan interest. So that value was not captured. But anyway, if that value had been captured, it would have appeared under finance costs, because it's also finance costs, right? The way you're financing your business. Okay, so I think after that, now profit before tax. So this one, we can just do the summation of the various items. And the reason why we can do summation is because the expenses are negative already. Yeah, so you can see 9,083,000. Now let's confirm, is this the same figure we have in our trial balance? 90. You can see it's the same figure, right? Meaning that we didn't leave any expense. Yes, David.
Margaret is unable to rejoin.
Sorry?
Margaret is unable to rejoin. The issue that we had before of could not connect to the video call is back again. So
what do you mean?
No. Oh, but she had joined.
Yeah, it was open.
Yeah, okay. She's okay now, I guess.
Okay. So, so you can now see the figure is the same. 9 is the same we have in the income statement. Okay. Now let's go to the notes that relate to the balance sheet now. Majorly these are the balance sheet items. Okay. So here, the only figure we can capture here at the moment is the installment tax, this amount here that was paid. So we can say equals, we can put a negative sign there, and then go and capture the amount that I said was installment tax. So this amount was under transactions. Transactions, 700. Now note that I'm linking directly from the transactions instead of profit and loss or balance sheet, because in the subsequent years, this income statement is going to have, this income tax is going to have other components, such as the outstanding balance in the previous year, the closing balance for this current year. So if you link direct from either the P&L or the balance sheet, you may link the wrong figure. Our interest right now is just whole transaction related to installment tax. And this we can get it from the transactions section. Okay. We are going to come back to the other issues, or the way we compute taxes. We can skip that. for now. Then we have the share capital. This one, you can just go to the extended trial balance and get the figure now from the balance sheet. So it's 100,000, so it's that figure. Issued and fully paid. Now note that, of course, legally or according to the Companies Act, there's what we call authorized and there's what we call issued and fully paid. So authorized is how much the company can, how many shares the company can issue. The ones it has issued so far and they have been paid for, this is what we call issued and fully paid. Now, in your financial statements, you take what is issued and fully paid because you may find that in cases whereby maybe the authorized is 100,000, but so far we have issued 50,000, equivalent to 50,000. Okay, so your figure should be 50,000, not 100,000. Then we go to the bank loan. So we get this figure. That's 1.4. Then from there, now we go to the property. That's the PPE section. Yeah, this one. Now note that we never had any opening balances, okay? Because we say this is the first year. So the only thing we have here are additions. So the additions section, motor vehicle, you go to the trial balance. Again, you don't think from the closing balances because these may have issues. I mean, not issues, but they may have balances that also incorporate the opening balances. But what you are interested in was the movement for the year. What transaction occurred during the year. So this we can get it from the transaction section as well as adjustments if there were any. So for now, we are interested in the motor vehicle addition, which is 4.2. Then we have computers. That is 200,000. Then there's furniture. $300,000. Okay. So of course there's a formula here which sums up. This sums up the opening balance, which should be here, but for this case it's 0. So this plus any addition, and that's how you get this figure. So again, same case, opening plus any additions during the year. You can also less, if in case there were disposals, you can add another row here for disposals. You less that figure to get the closing balance here. Now, once you have that, the next question is, how do you depreciate your assets? Now, remember that last time we had touched, I don't know whether, I think there's a time we mentioned this on how do you depreciate your assets. And we said that you can come up with your policy as a company, but if in case your policy differs with what KRA provides, then you are going to have what we call temporary differences. Okay, so the amount you have charged and the amount KRA is allowing you to charge are different, leading to deferred tax. Now, the treatment of deferred tax is a bit complex. So to avoid that scenario, most companies just prefer to go with the rates that have been provided by KRA. Okay. So now to do that, what you usually do, the most recent, we used to have 4 classes in the previous section where you are charging for the heavy machinery. We had that 7.5%. Then there was computers 30%. Then motor vehicles 25%, and finally we had furniture or equipment 12.5%. Now I think they created 2 classes, or they did away with the 4 classes and just combined them into 2 classes. So for the computers and motor vehicles, you're using the rate of 25%, and then for the equipment and furniture, you're using a rate of 10%. So we can just adopt those rates to avoid the issue of deferred tax at this point. So the charge for the year for the motor vehicle, as I said, this is 0.2%, 0.25, sorry, 0.2, is it 0.2 or 0.25? Anyway, we are going, let me just confirm that. Just a moment, I check. We have tax deduction, capital allowance. Yeah, it's 25%. Okay. So we can use the same rate here. So 25% times the balance, because this is straight line, meaning it's not reducing balance where you see that the previous charge should be less. I mean, the current charge should be less than the previous charge. They use straight line basis. So we can just adopt the same. Then for computers, again, the same rate. For furniture, that one you are going to use 0.1%, the total furniture value, which now gives us a figure of 1.3. Now this is the charge for the year. If I go back to my notes, NT7, there was a section for depreciation for the year, this year. So this is where now you put that figure, okay? So you say equals, and then you get the figure from your PPE schedule. This amount here, charge for the year, okay? So of course, this means that your income is going to decrease, but you're going to come to that. Now, moving on, after that schedule, now to determine your closing balance here, the net book value, you take the overall cost so far, which should be this, then you less your depreciation so far. So this amount here. Okay, then I can just copy this formula, paste it there and there. Yeah, okay. So you can see there is a note on deferred tax, but of course, for these cases, we are not making any provision because there is no major.
So I have a question.
Yes, David.
Why did you raise that value?
Sorry?
You took the total cost and raised with the depreciation.
Accumulated, yes, to get the net book value, yes.
Well, maybe I don't understand what net book value is.
Mm-hmm.
Because I'm wondering, why are you raising the depreciation? The cost,
okay.
You raise the depreciation.
Okay, what happens is, when you are presenting your financial accounts, you know, if you bought a motor vehicle like 3 years ago, the value of that motor vehicle is not the same in the current year, okay? It has been wearing out, okay?
Mm.
So what happens is that when you are presenting your books, there's a policy. I'm not sure. I'm not remembering the policy at the moment, but there's what we call fair presentation. Should be you're using the fair. Is it fair something? I can't remember. Okay, once I confirm that, I'm going to I can put it in a discussion forum. But you present your assets or your liabilities using a fair value. Okay, so you can't say that the asset that you bought 3 years ago has the same value at the moment. You have to go with what is the expected value of this asset at the moment. Okay, that's why we raise depreciation. Because
I'm wondering, you are raising the total costs.
Okay, you are taking the cost, which was 4.2 in this case, right?
Mm-hmm.
Then you ask yourself, how much has this asset worn out? Okay. In other words, if it's a motor vehicle, it has been wearing out, right? So by how much has it worn out? Now, what we make is a provision, an assessment. Of course, it may wear either more or less, more than our estimate, or maybe less than our estimate, depending on how you have used it. But still, you have to come up with a policy because you are not necessarily sure how has it been wearing out, right? So our policy says this asset, every year, this asset we call motor vehicle is wearing out at a rate of 25%. In other words, it's losing value at a rate of 25% every year. Okay? So that's why we raise depreciation, so that at the end of the day, because our financial statement should give a true and fair view of the financial performance and position of the company, you have to include everything, including how much you have lost, the value of the asset that you have lost. Do you understand now?
Yeah, that's me.
Okay. So we can continue. Is that okay?
Yes.
Fine. So deferred tax, as I said, that one we have no any provisions, but of course we had a note there to say no deferred tax provision has been made. So we move on to the next thing. NT10. Now here we have cash and bank as well as payables. So cash, the cash amount, you go to the extended trial balance, and Yeah, under this, cash as the cash amount. Then we have the bank.
Excuse me, Zach.
Yes, Elizabeth. Yes, continue.
I was requesting.
Yes.
I was requesting that you incorporate a practical case of the adjustment application.
Okay, fine. Let's just finish linking the accounts. Once we finish linking the accounts,
okay.
We can now come up with a scenario where we need to make an adjustment. You are talking about the extended trial balance, right?
Yeah.
Yeah. We can now, we can